I'd love for you to just kind of introduce the new acquisition from Gray Capital and a little bit about what drew you to it. It's on the tip of my tongue. I'm really excited about it for sure.
Well, yeah. And I think it's a question of, why are we compelled to make an investment now? We haven't invested in a deal, well over a year. We haven't hadn't acquired a deal until earlier this year. We got a deal in Evansville, Indiana, River Club that we successfully closed. Great asset, more a value add strategy. And, historically, Gray Capital, we've had two primary investment strategies when it comes to multifamily. And, they're relatively similar, but slight differences. One is more as our value add silo, which we're looking at properties that aren't too old, really kind of built in the 80s and 90s, maybe early 2000s. They're looking for they kind of need some physical improvement, but they're stable, they're occupied. They can produce cash flow day one, but there's a true opportunity to go in and physically do some things. Fix up the units, fix up the clubhouse. To bridge the gap between where that property might be and the surrounding assets, but then force appreciation by charging a premium on the rent after we've renovated the property, making it nicer, making it look like the newer properties, but still, and this is the key to all of our investments, add the value to the asset. Show the value to residents, make it compelling that this is a really nice property and they're getting a true value relative to the other options in the market. It's really important to understand what the comparable properties are, not just what their rent levels are, but what do the units look like? What's the square footage? What is the finish level? When that prospective resident walks into that unit, what's the feeling that they're going to get? What is the feeling that they will get when they drive on the property, walk in the clubhouse? And then how do we line up? These are, certainly money, budget-driven decisions, but they're also highly emotional. Where you're going to live, where you're going to spend your time, where you're going to raise your family. And so there's obviously a lot of emotion tied up in that, envisioning the time I'm going to spend the next year. So, that's the value add strategy. Core Plus is a little bit different, and Core Plus is really, we're always, looking for high intrinsic value, but typically we're looking at what's a property that is, newer, very high quality, that the rents are still though, a couple $100 below some of the comparable properties in the market. And often we find opportunities, we're buying these from most often, large institutional groups that are mostly, not always, but most of the time, not local to the market, not even local to the region, have, third-party property management. We can go in there and just run them better and find sometimes some opportunities to add some additional value as well. And so this new opportunity, it's in our backyard. You said, you're from Indianapolis, I'm from Indianapolis. Our headquarters is in Indianapolis. We're actually just right down Keystone Avenue from the property. So you said we know it really well. We love the Indianapolis market. If you're a listener or viewer of the Great Report, we talk about it all the time. I kind of took the Indy for granted for a couple of years. I was reading everything I could. The Sun Belt sounded like the best place to invest. That's where all the population growth, and I'm from Indy, so I just kind of took it for granted a little bit. And until I started doing a lot more research in some of these other markets and underwriting deals in the Sun Belt, and in the Southwest and everywhere, because, what I had read was that, you can invest anywhere in the country. Don't just look in your backyard. If your backyard is good, and maybe if your backyard isn't even as good as maybe another market, but if it's pretty solid, your knowledge of that market and your relationships in that market lower the risk and give you a competitive advantage that when investing out of state, will never have. Like, I will never know a market like Indianapolis. I could live somewhere else for a couple of years. I could spend months somewhere. I'm not going to know the intricacies, the history, the little pieces of facts, what was there 10, 15 years ago, and then who all the people were. On the opportunity that we have right now, Solana, like all the comparative, it's so easy compared relative to a property in a market that I'm not so intimately familiar. Like, I know all the comps so well. Like, I remember when they were built. I know who built them. I'm friends with a lot of the developers. I'm an investor in some of them, or I was an investor and we sold it. Or I know the operator that owns it now and that runs it, or I know the property management company. there's so much nuance and detail that you can have when you're investing. On the flip side, you don't want to get like too emotionally caught up in a deal or a market. Just because this is our home, this is our backyard, and you live nearby, like that's not a reason to do anything.
Yeah.
But when all the numbers make sense, the market makes sense, you can operate it. You have to start moving forward. And on this deal, it's a big one. We're going to be raising almost $30 million. And so we had to buy it at a price where we could produce and project really good returns, so we could attract that type of capital.
Yeah.
But for us, it's a great opportunity to own a high quality piece of real estate in an incredible location on the north side of Indianapolis, Washington Township schools, best schools, in Marion County, in Indianapolis, immediately down the street from like all the best shopping, where like a ton of the office jobs are, where a lot of the growth is, they're just immediately north, and Carmel, Fishers, all the north side suburbs in Hamilton County. And then, the rents, Matt, $200 to $600 below, just relevant comps. You go down the street, property was built in the same year, not as nice of a location, and the rents are $400 more. So to me, that's like a very direct path to organically move rents. We can operate it more efficiently. We're local management. We're down the street. We've got our whole team here, so we can run it smoother for cheaper, move rents to market. But then also, we look, maybe we can inject some CapEx and make sure that the property is going to be modern and relevant for the next 10 years. The property was built in 2014, so it's newer. That they're building how they built it then is similar to how they're building them today. The interior finishes are 95% of the way there, but there's a couple things that we can do to not spend that much money, but to really give it the legs to be able to perform and stay relevant for the next 10 years. So then when we go and sell it in year 7 or so, the next buyer is going to come in and say, all right, this property is ready to go. It's relevant. I'm not going to have to put nearly as much money in. And so but we don't need to redo the countertops or the cabinets. It's more smart technology, keyless entry, smart thermostats, new kitchen faucets, some new lighting, just to give that impression. So we're going to have a great first impression coming into the property. We're going to paint the exterior. That's what we're doing a lot of these Core Plus assets and strategies. It's a couple years old. Give it a new, bold look, paint the exterior, and then go in, make some really small tweaks to the interior finishes that draw the eye. You sell real estate based on the kitchens, right? You're going to walk in, see a really nice statement piece, faucets, some nice new lightings, the technology on the wall, the technology at the door. I mean, just the keyless entry. What's going to separate a nice enough but older property versus the brand new thing? I mean, when
as a sign that someone's been renovating or that someone's paying attention to it.
If you're using if using the physical key. My 8-year-old gave me this thing. But if you're using the physical key, which is fine, I like physical keys. But using physical keys for the last 1,000 years, right? We've got cell phones. If they've just toured the brand new property down the street, and the leasing agent or whoever is touring them opened the door with their phone, and then you go to the next property, and the leasing consultant is like fumbling with keys. And they're using the key. There's nothing wrong with the key, but it's the perception of, is this a modern new apartment? Am I going to get the best? What kind of experience am I going to have over the next year living here?
Well, that's what's interesting too, is because you glance at this property and you're like, well, maybe it's too nice, I
got a comment on LinkedIn. They're like, oh, it looks like a trophy asset.
And what I'm saying is, it's not, it's not necessarily in like the wheelhouse of a value add or really of our last investment project. That was way more of a value add, and it was something you could wrap your head around, and that's something almost comforting. Even when I'm talking with our investment team, is like, well, people can see the value. That's easy for us to pitch. But when you see it's a really nice asset, then you're thinking, oh, well, everyone's going to compete with it. Oh, well, where can I add the value if it's already so nice? And is it a thing, like we talked about, where it's not risky enough to be profitable or to have as high returns? Now, some of what you said there is you look past it and you kind of see opportunities here, but I keep thinking about the moment too, and that's created enough risk for people, maybe to jump out of it.
No, it's a really good point, and you're right. A lot of investors, will look at a deal, not all, but a lot, and they'll want to say, where is the value add? What are you doing to the property? Are you just going to buy it and just hope that things just keep doing well?
Yeah.
And there's not, and the rub there is, and why investors ask that, and it's a good question. Is that it's like, all right, can you quantify? You're saying you're going to grow the property above maybe the organic rate of growth. Okay, what are you going to do to achieve that? Why hasn't that been achieved in the past? And quantify it.
Yeah.
And usually pointing to, we're going to mark to market and move rents up. That can be a good story, and that often can happen. But a lot of investors, they want to see something more. They want you to see you doing something and changing the property, making some sort of investment into the property, especially if you're going to be holding on to it for a long time. Because sometimes you can buy something and you don't need to do much. It's in great shape. But things happen. It's real estate. For example, this property, it was built in 2014, but a lot of the trim on the siding, the white trim, it's fading. It's weathered.
Yeah.
And from a distance, it looks nice, but then when you get closer, I'm a prospective resident, maybe you don't notice it, but all the details add up.
That's
so
what
it's
I was
like,
thinking, yeah.
But it's hard to do that if you don't plan to do that stuff from the beginning. You can't 2 years from now say, let's paint the exterior.
Well,
let's go find the $500,000 or a couple $100,000 to paint the almost 400 units.
They add up to you from your perspective, and they also add up a little bit to the renter. Maybe they're going to pass over something because I don't know, it looked a little dingy.
It looks a little beat up.
Yeah.
No, exactly. And then when they're comparing the brand new,
exactly, comparably dingy.
Well, no, it'll still be nice, but no, it's like people like living in the nice and the new thing, right? Shiny object. So the idea is, if we polish it up, make it shiny, add all the details that make someone click on this is new, modern, and I'm getting that same experience, but then providing it at a discount. $200 to $400 below, the property down the street. That is, it's newer, but basically same area, same market. The floor plans are similar. Ours at Solana, they're actually larger than the comps. Some of them are nicer because they were built as condos. And so when someone tours both properties, they really have to ask themselves, what is the difference here besides the price?
Yeah. So what is the what do you think Solana has that's unique? Yeah. and it's
throwing the softballs.
Yeah, I know.
No. So so great. Couple things. One, large portion of the property was built as for sale condos back in 2009. It was about 40 units, but they built them as condos. And so there's some very large units that were, the finish level is much higher end than your typical apartment. They're not charging as much as they should be for these units, but in general, the build quality is higher than your normal apartment.
It's like a resort hotel.
It's like a resort hotel.
Yeah.
But then the second piece is, again, the location is good, but there's other properties that are in this location. We're on the water. Not just we're on the water.
Yeah.
We've got a 20 boat slip marina that we can rent. You can rent a slip. You can put your boat in. We're on a 22 acre bay that we own that's attached to the White River. There's no other apartment community in Indianapolis that has direct White River access. And the White River is the main river that comes through Indianapolis, through downtown. It's a beautiful place, the scenery. And so when we talk about experiences and lifestyle and what the modern renter, the millennials, Gen Z, younger Gen X, what they're looking for experiences.
Yeah.
And when I look at the comparable properties that again are $400 to $600 more a month, they're behind strip malls, which can be convenient, but you're in a parking lot, literally, or you're behind a mall in a parking lot, or you're behind an interstate. Maybe it's newer, but no interstate access. Versus living on this, majestic, on this majestic property, waterfront property. You literally have bald eagles and herons going over you every single morning.
Yeah.
It's a different vibe completely.
Yeah.
And I've mentioned this a couple of times. I'm like, I guarantee the mental health of people that are living in Solana versus surrounding properties is notably higher. maybe it attracts people who are happier because they want to live in that type of environment, or maybe the environment, improves that mental health in general.
Yeah.
But it is...
You pulling in, you don't want to pull in and right behind the Donatos. No offense to Donatos, but you don't want to pull in behind the... you don't want to be pulling in behind the strip mall. You'd rather be pulling in next to the lake or the bay, or to look out on something that's a little bit more...
I would, and maybe not everybody, but I would.
Yeah.
And I think a lot of, again, the renters who are targeting Gen Z, millennials, younger Gen X, that is what they're targeting, looking for as well.
I'll add here too, and maybe I'm stealing a little bit of your thunder, but I think that the timing of this is great from from an interest rate perspective, or from like a market perspective, but also from that specific perspective of the White River and the stuff that the city of Indianapolis is doing with the White River. They're doing this kind of big dig project where it's supposed to really dramatically increase the quality of the White River in the city, and I am seeing a lot more attention to the people. People are gobbling up these riverfront homes. They're coming in from out of state and they're like, what are you doing? This is great.
Yeah, no, the river has been ignored from a lot of people in Indianapolis for a long time.
We grew up here. It wasn't great for a while.
Yeah, no, it wasn't. It was relatively polluted. There was a fish kill, and that's what a lot of people think of the White River.
Yeah,
at 25 years have gone by now, and it's improved considerably.
Oh yeah,
and I've spent a decent amount of time on the White River now, and people are missing out. And the people who have been on the river and have experienced it, it's an eye-opening moment, because it's a great resource for recreation. And
it's not navigable by commercial vessels, but it winds its way through the heart of Indianapolis. It's funny, we've got this big river, and then it's like our canals are the ones that have a lot more development. Yeah. And there's a downtown canal, and there's a canal in Broad Ripple or something, but it's the river system, I think, is really waking up, and there are more people that I see out on the river, out on boats or kayaks or whatever, and it's only going to increase. So it's really exciting, especially the fact that this big project is going to be done in 2025.
Well, and they're already seeing a lot of the improvements right now. I think they've done most of the work. I had a meeting with the executive director, the Friends of the White River, which is a local nonprofit that we're looking at having a partnership with to help coordinate. There's some grants out there for wildlife restoration, natural grasses, things like that. They want to do training with our site staff, landscapers. What's the best way to maintain this environment? But in the conversation with him, a lot the big dig, which they're building this massive tunnel underneath the city. And other cities are doing similar projects. As in the past, they've dumped sewage into the river.
Where does it go when it rains? Well,
and so they're basically building this massive, huge. It looks like a nuclear fallout shelter type massive thing. This massive tunnel where it's basically going to be like a holding tank. Which has already dramatically improved the water quality.
That's great.
Yeah. So it's exciting. I think it's going to finish up next year.
Wow. And there's multiple other projects, not just the Big Dig, but that have been kind of bubbling to the surface throughout it.
Dig Indy, I think
Dig Indy. Okay, all right.
Yeah, Big Dig was in Boston.
That's what I thought. Yeah. We've been calling it that.
It is. It's the big. Yeah, I know.
But there have been other projects in Indianapolis seeking maybe they want to build a little beach here, and I don't know what state there are, but they're kind of bubbling to the surface. People are taking notice, and they're planning for the future, and to have this property be here already, and there's already a boat dock, there are already kayaks there, and there's just so much opportunity to be built out, and as the White River becomes more appealing to people.
So there's all of what we've been talking about here, the river and all of that. I think it's like a force multiplier. It is, but it's like the cherry on top. It's the icing on the cake, whatever you want to call it. You have to compete based on value of the apartment, the individual apartment, based on the rent levels of other assets nearby, given the location, the proximity to jobs, employment, restaurants, retail, all of that. And if you have all of that, and you have the finishes that really compete, and again, you're offering it at a deep value, then you just step in and say, now look around. And you just can't replicate that natural environment. And again, some people want to live behind them all.
Well, and here's something that I was thinking, though. What if it is too good to be true? There's always something about if it's too good to be true. What do we do?
What do you mean?
What if there's like what do they call this? I guess
Swamp
a huge
monster?
sinkhole, a swamp monster. What if there as floorboards could everything could collapse in on itself the minute you touch it? Like, how do you kind of kick the tires here? And what's that process of determining whether, like, all right? Because I know we've had. We've checked it out, but what's the real process where you can kind of eliminate any doubt, I guess?
Well, you're never going to know when you first go in and you put a place of property under contract. You do as much as your due diligence up front as you can, and before you're under contract.
Yeah.
Obviously, you can't get in and physically inspect every single unit before you're actually under contract in your due diligence period. But you got to do as much as you can. Be on site as much as the broker will allow you.
Yeah.
Drive through if you can. In off hours, multiple times a day. And every time you're there, you're looking for different things. You're looking at, between, how many cars in the park are parked in the parking lot at any given time to see, okay, are people working, what type are people who have third shift, but what's the occupancy at a given time? What type of cars are being driven at the property in the residence zone? But then obviously, there's the physical condition of, you're looking at balconies. Are the columns, is there any swelling going on?
Yeah.
Is the foundation doing any settling? If it's raining, get over there. You don't tour the property when it's a beautiful day. It's a great day to see it. That's great for the seller. It looks nice. But, if there's a drainage issue, you're not going to see it. So go after it rains. Go at night, go in the early morning, look at the siding. And these are all the things you start picking up clues, because you can only, it's like we're doing a surface scan. We can't see inside of it, just yet. And so what are all the different pieces? Because then if you see deferred maintenance on the outside, you can anticipate there may be some on the inside as well. And so then you try to do as much to anticipate what we think we're going to need to bring to the property once we buy it before we were under contract. And so we're building out our budgets. But then once we get in there for due diligence, which as soon as we finish this podcast, I'm popping over there and we're basically using the property as we're doing physical inspections. We have our whole asset management, property management, construction teams over there today, using it as a forward operating base, because I've got going to meetings as well with some partners and potential investors that are on the north side of Indy. But we're getting into every single unit. We're going to walk 100% all 384 units for a couple of reasons. One, we're assessing the condition. We haven't been in all the units yet.
Yeah.
The managers haven't been in all the units. Some people they started working there, a couple months ago. There are some units that have been just so highly occupied, like the condos, that like no one's seen them. Like except when they were turned a couple years ago, and that maintenance guy's not working there anymore.
Yeah.
Maybe someone's been in there for routine deferred maintenance or preventative maintenance check or changing filters, but it's like no, a maintenance tech has been in there. So you actually put eyes on it. We're cataloging, with the condition of the mechanicals, what type of appliances, have any upgrades been done. So I don't know how many times you're told that people haven't upgraded any units, and you start going in, you're like, these are upgraded units. You've already spent money. You've replaced appliances.
Yeah.
You've already done all of these things.
Guys come in with like a checklist of this is this.
Exactly. Okay. We go through and we have an app that we use. The team goes through and we go through and check and monitor, make sure everything's filled out, complete. So because that's our opportunity to take an inventory. There's no other time that we're going to be able to go in and get into every unit and to see and to catalog everything that's in there. So if we do say, hey, let's switch something out, let's change out this light, this appliance. Well, how many have already been switched out? Yeah. So we could say, there's black appliances there now. We want to switch out to stainless steel. Well, there are some stainless steel appliances at the property already, but how many? And it's so expensive to send people to do this job again. Yeah. Lesson learned, previous deals. Like, do it right once. You measure twice, cut once. I mean, that's as simple as it is. It's not sometimes due diligence, and this rubs me the worst way, of due diligence, especially these unit walks. That's why I need to get over there.
Yeah.
To make sure it's not a checking the box exercise.
It's not a formality.
It's not a formality. And so often people are like, we got to walk these 384 units, get in there, and we just need to get it done so we can go to lunch. And so you're going through and you're seeing how quick you can do it, and they're check, 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 check. And it can be garbage in, garbage out.
Yeah.
And they're like, well, we actually didn't log some of these things, or I wasn't checking on that. It's like, well, we were really going. It's like, well, you were really not doing the job. Yeah. So it's critical. Take your time, get it done. You got 30 days of due diligence. You don't need to do it all in one day. Obviously, logistically, that makes sense. It's hard to get all the people in one place at the same time to knock it out. But you have to be thorough. And so it's not only just units. You're checking mechanicals. You're checking foundations. You're checking windows. Obviously, you're looking at roofs. We're using the drone to inspect everything we don't want to trying to get on a ladder everywhere. You're inspecting everything that you can't see from the ground. You're scoping sewer lines. You're looking at drainage. Hopefully, there's some rain on the ground. If not, we'll have to go back another time to see what it looks like.
Any kind of like paperwork type of due diligence that you're doing at the same time?
Yeah. So we're talking about the physical due diligence of the property. The second part is the financial aspect, and so the large part of that is the lease file audit.
Okay.
And so you got a rent roll here. But what you do is oftentimes the rent roll doesn't match up with the leases, and so you've got your rent roll, and then you take a look at every single lease, and you're matching the two, making sure everything is correct, everything's accurate, there's no discrepancies. But you're also seeing if there's anything weird in the lease, and then also you're noticing things, or you're looking out for things like pet rent. Okay, I've seen every single unit's got a dog.
Yeah.
But only half the units are being charged pet rent. What's going on? Do you not know the pets? They get some deal. What's the story? You can find units that you didn't know existed. Like literally, it's not on the rent roll, but there's a lease for it, and it's like you have 385 units. Or there was a down unit, and they're like, oh, we just forgot about. Like literally, I've been to properties when there's been like 4 units that they were like, oh yeah, by the way, actually, like, oh well, we've been using that as storage, and so you've got these 3 other storage like sheds full of stuff, and they're because people get lazy, and again, out of state, third party management from far off, and that's all. It can all turn into great opportunities.
I am curious now where we are, and how you've mentioned how this is probably the largest raise that we've done. And what your thoughts about it are. I'm excited. I think it's fun to it's gonna be fun to pitch this really beautiful property to people, and especially our hometown. We've been talking it up for so long. It's so great to have it in our hometown. But I'm not the one that has to talk to investors all day. That's you and the people in our investor team, Blake and Griffin. What are your thoughts about the raise? How's it going? Even though it's only been like 3 days and there's already been like major news about it, and I just can't keep up.
I think it's been 3 days. We've got about $27.5 million to raise. That might move up or down. When we get through due diligence. That's a whole other piece of refining the business plan once you've gotten in there. But it's intimidating to start to say, hey, I've got 30 days to basically raise almost $30 million. And not everybody does it this way. Some people have like all the money in their bank account ready to go. They're buying it themselves, or they've got pre-committed funds. We have a lot of investors that give us soft commitments on this type of deal. We'll definitely do this. And we have programmatic relationships of people who just come into every one of our deals, but not necessarily adding up to $30 million. And so it's we don't always know where it's going to come from. But we know what we try to do is, quantify how much activity is going to be required to get there, how many investors, and drawing the picture, really in a graph or in a chart of, what that looks like. Even though I don't have names of the types of investors. And so for example, on this project, Solana, open to accredited investors only, we can't do it by raising $100,000 at a time.
That's like 200 of them, is that? I don't know how many.
Maybe
That's
add a zero.
Yeah.
It's
20 million and whatever. It's a lot.
It's a lot. $100,000.
That was 20 million. Sorry, I wasn't saying 27, but
yeah, no, it's over 2,000. It would be over
Okay.
2,000 individuals.
yeah, yeah.
At $100,000. That doesn't even get us there.
Well, and I
don't have time to have that many conversations.
Yeah, yeah.
So we have to have conversations with larger investment groups. So it's family offices, it's registered investment advisors, it's kind of quasi-institutional groups. We're not really pushing for joint venture like JV equity right now because although we're having conversations, but our investors invest with us and me, and they assume that we're controlling the deal, and to have a major investor that can kind of pull some of the strings. I'd rather it can work out. There's great partners. I'm not saying you never even do this deal, but right now we've got the interest.
Yeah.
Where we can put together a really great group of some family offices, registered investment advisors, and then some our sophisticated ultra high net worth accredited individual investors.
And I think that it's comforting that we've had years to build this network of people through the deals that we've done, through the conversations that we've had, and through the through the investors that the people that we've even worked with.
We've got a track record.
Yeah.
I mean, and people are like, how do you do this? And we started basically at scratch, with very little contacts, and grabbing coffee with people every once in a while, and then started and made a YouTube video that wasn't good at all. It's still on our YouTube channel. Did it, during COVID in my basement. This is when we were really ramping up raising capital. Because before that, it was much more kind of just immediate friends and family, and raising a couple $100,000 here or there. But no, the relationships build up over time. But then it's also people judging us for what we've done in our track record, and like you'll hear me if you're pitching you on Solana, you'll hear me say this, but like we've got a great track record of the deals that we've done in the past. Over 30% IRR. Everybody's got a decent track record over the last cycle. The business got so easy at the end. 2020 and 2021. 2021. Even 2019. I mean, the money was available. Interest rates were zero. The money was free. And rents were growing by 20%. So like you had to really screw it up. And so it's like, we've got 2 times what our returns are projected to be, at 30%. I am proud of that. But I am much more proud of our track record over the last 2 years of all the things that we didn't do, the deals we didn't buy, how we didn't overpay, the fact that our decision to not use bridge debt and floating rate debt in certain situations when we saw the market moving, and that's allowed us to not have to issue any capital calls, to not be distressed, to be in this position, to communicate it, and doing like what we're doing right now, Matt, of communicating our thoughts on the market, our thoughts on deals. And doing, how long have we been doing this now? 3 years?
3.5, 3
years.
Yeah.
So every single week, telling whoever wants to listen, our thoughts on the market, and being consistent about it and being transparent. Over time, that snowball, builds up. So it's just it's consistent action. That's what led to this. And then we say, okay, let's paint this picture of what it could look like, and let's start filling in the gaps. So we're not there yet. We'd love folks who would want to participate. Go on to greatcapitalllc.com. You can find it there, or I think solanaindy.com is going to be up and running pretty soon.
It should redirect at this point. But
so solanaindy.com. Learn more, get the deck, schedule a meeting with us, and then we've got a great, probably the best investment portal in the industry. You can do all your due diligence. We're transparent. We throw it all up there.
do you want to type in solanaindy.com? I can cut this out if it doesn't work, but I'd love to see that. Beautiful landing page. Now
I was on GoDaddy. Why not a custom domain? And I wanted to get like Solana.invest or something like that. Solana Invest was $4,000. Invest Solana was $100,000.
Oh, geez.
Solana in Indy was 23 cents for this year.
Oh man.
I'm like, okay.
That's funny.
Yeah, I was like, I'll buy, and it was like 3 years for $40. I shouldn't have even bought the 3-year thing, but
there we go.
Perfect.
And now our properties have their own websites too, like the ones that for gray residential, like live at.
Oh yeah,
places.
Yeah. So yeah, you could pop on over to solanaindy.com. You can log in if you're already an investor, sign up for the portal, but also schedule a meeting. Watch the full. We have a full deal preview video that really is me for 45 minutes, giving you a full breakdown of everything about Solana, the deal, our thoughts on it. And then, it's a beautiful asset. I'm glad we actually get to see some pictures of it, Matt.
See that picture of that guy fishing?
Yep.
I just wanted to add that as a little color.
Yeah,
lots of things happening on this on these waters.
Yeah, you did a good job with this one, Matt. So fill out the form, get the deck, schedule a meeting with us. We'd love to have a conversation with you if it's a good fit. And again, you do have to be an accredited investor to participate. That's the SEC telling us that. It's not us. We think you should be able to do what you want to do with your own money. But it's exciting, Matt.
I know this is going to be a fun one. I am excited. It is the biggest number that we've ever had to tackle, but it is something like, oh man. I mean, it's a great product.
Every time everyone's like, "Do you think you can raise it?" And I'm like, "Well, I've been able to do it every single time, and we won't know until we start."
Yeah.
And we'll be able to. The type of asset, and again, we bought it at a price, and this is what we told the sellers and the broker. I said, because they really wanted us to obviously pay more money. And there was another buyer that was offering more money than we were. But it was very clear that, look, I'm not going to put this, if we're going to put this under contract, we're going to close.
Yep.
But in order for me to close, I have to raise the money.
Yep.
And so I need to get it at a price that can generate the returns with reasonable assumptions that it's going to make that very easy to raise the money, rather than, like, it can't be a marginal deal. It can't be like, well, it's low risk, so it's a low return. It has to be a advantageous risk and return profile. It needs to be lopsided. It needs to be asymmetric. And the fog of war, and when we did put under contract, interest rates were really much higher. The 10-year was. They've come down since then. We used the treasuries being higher as kind of covered. Like, look, we couldn't. I mean, because if rates are going to go to 5% or more, that's what the pricing is telling us, and it's relative to cap rates and other buyers, were getting out of the market. We held steadfast, confident about the long-term fundamentals, the market, the property. That we stuck to our guns, but had to be at a price that made sense for us and for our investors, and we were confident. We'll be here with updates every week. You can hop onto SolanaIndy.com if you're a accredited investor to learn more.
Super exciting.